Hey everyone, and I'm about to share something that might make certain people uneasy. If our financial system is fracturing the way it appears to be, then asking, when should I sell my precious metals, might be approaching this from the wrong angle. If that's your question right now, you could be standing on a sinking vessel negotiating the cost of your escape route. Before we continue, I'd appreciate a quick favor. Analytics reveal that most viewers haven't subscribed yet. If you're finding this valuable, please subscribe and comment below to let me know you're engaged with this content. Let's dive in because recently we witnessed gold approaching the upper 4,800s once more, with silver testing the mid to high 90s. I understand exactly what this triggers mentally. A voice whispers, "This must be the peak. Take your gains now. Lock them in before they disappear." That instinct isn't irrational. It's been conditioned by decades of traditional currency thinking, decades of charts measured against depreciating paper, decades of advice treating the current system as permanent. But consider this perspective. What if the measurement tool you're using is what's actually deteriorating? What if success isn't converting to paper currency, but rather carrying tangible money forward and eventually exchanging it for productive assets when valuations favor you dramatically? That's what we'll explore today, systematically. We'll discuss recent statements from elite institutional investors that essentially acknowledge what's happening behind closed doors. We'll connect this to current bond market signals. Then we'll address the fundamental question. If you're not selling for currency, what exactly constitutes an exit strategy? How do you recognize the right moment? I'll provide you with a functional framework, straightforward, memorable, and actionable, so you're not dependent on emotions or panic responses. One more thing before the core content. Check the description for additional resources, including access to premium channels and membership options for those wanting deeper analysis. The truth behind fancy language. The mainstream financial establishment masks reality with sophisticated terminology. They don't acknowledge system instability. They mention liquidity events. They avoid saying debts are unpayable. They reference fiscal adjustments. They won't admit declining confidence in paper assets. They describe risk-off rotations. Occasionally, however, someone influential speaks plainly. Recently, a prominent billionaire fund manager stated at a major international conference that the monetary order is experiencing breakdown. Not minor disruption, the fundamental framework, the foundational belief structure itself. When individuals at that level make such statements, pay attention. That's not entertainment, it's a signal. Here's what's crucial. When currency is created, it exists as a liability born from debt. There's always a corresponding obligation somewhere in the system. Precious metals carry no such burden. No counterparty can default. No institution can collapse and eliminate your position. That's why during system stress, capital doesn't flow toward more promises. It flows toward what physically exists. So let me pose a question you may not have considered. Why would you abandon your safety mechanism while conditions are deteriorating? The real strategy. I understand the objection. Everything has a selling price. Surely there's a number that makes sense. This is where the answer becomes unexpected for those still mentally anchored to conventional currency units. My approach isn't selling precious metals for additional paper. I'm planning to exchange metals for tangible assets when ratios become extraordinarily favorable. This isn't semantic wordplay, it's strategic thinking. Selling for currency assumes currency is your destination. If the monetary framework is fracturing, currency isn't the destination. It's either a temporary bridge or, more likely, a trap. Envision measuring wealth not by currency quantity, but by how much productive property can I acquire without requiring institutional permission. Land, businesses, equipment, inventory, income-generating real estate, agricultural property, energy infrastructure, even a stable, debt-free residence. The transition from metals to these assets doesn't happen by attempting to time market peaks. It happens by monitoring ratios and behavioral patterns, the framework. Think of it this way. We're aboard a monetary vessel experiencing structural failure. Most people continue their normal activities because surface conditions seem fine. The market scoreboard still updates. But some of us sense the underlying instability. We observe the warning signs, the nervous reactions from those who understand the systems. Precious metals are the emergency vessels. Gold is the more concentrated option. Fewer people can access it, but it stores significant value in minimal space. Silver is more accessible but bulkier, with extensive historical use as everyday currency. Here's the key. If you recognized impending structural failure, you wouldn't surrender your emergency vessel for casino tokens. When do you sell? When your metals can purchase something providing greater long-term value than safety itself. When they buy you control, stability, and sustained productivity. 3 critical filters. Filter 1, system signals. When bond markets fracture, currencies depreciate, and central banks accumulate gold, that's not a moment to reduce protection. It's a warning against premature profit-taking. The costliest error during monetary transitions is exchanging real money too early for paper claims just before those claims get repriced. Filter 2, ratio signals. Instead of asking, is gold expensive, ask, what does gold purchase? How many ounces buy property in your area? How many buy reliable transportation? How many secure income-producing assets? When ratios reach historical extremes, meaning real assets become inexpensive in metal terms, that's when you begin exchanging. Most people do the opposite, buying assets when expensive in metal terms because nominal prices feel comfortable. Filter 3, personal signals. Your circumstances matter. If you require liquidity for emergencies, family protection, or cash-flowing business opportunities, exchanging a portion makes sense. The objective isn't holding perfect positions while missing opportunities to improve actual living conditions. It's surviving and thriving. Market connections. Bond markets should be finance's stable corner, predictable and boring. When bonds move erratically, that's a warning signal. Recent volatility in major economy government bonds matters because the mathematics are brutal. Massive debt loads plus rising rates create politically and economically impossible servicing costs. Policymakers respond predictably, capping rates, creating money, or changing rules. All three scenarios favor hard assets long-term, despite volatile transitions. Add genuine inflation, not sanitized official versions. Recent UK consumer data ticked higher. Even accepting official figures, the point remains. Cash deposits lose purchasing power, and interest rates rarely truly compensate after taxes and real-world costs. This is the silent tax, never voted on, punishing savers while rewarding debtors. Once you recognize this clearly, you stop viewing precious metals as investments. They become stored time, stored labor, stored purchasing power, redeemable later when opportunities emerge. Trading versus protection. There's a role for speculation, but during monetary resets, speculation is where people get shaken out. Paper markets move violently, prices fluctuate, headlines frighten, commentators mock. That's intentional. They want you selling safety because a chart turned red briefly. For genuine protection, mentally separate holdings into buckets. Bucket 1, core protection, never touched, except for major life upgrades or generational assets. Bucket 2, tactical, where skilled participants can take gains, rebalance, or trade movements, but never risking core protection for tactical wins. The psychology trap: metals rise and people feel brilliant. Metals fall and they feel foolish. This emotional oscillation reflects traditional currency thinking. In sound money thinking, you measure position by ounces, not paper pricing. Paper price represents a stressed system's opinion. Ounces represent physical reality. When asked, when are you selling? I repeat, I'm not selling insurance because it became expensive. I'm holding until the world offers exchanges too advantageous to ignore. Practical thought experiment. Imagine a future where quality land costs 1 gold ounce, where productive farmland prices in metal ounces rather than fluctuating currency units, where those holding real money can build while others beg for loans. In that environment, the sell decision isn't about price targets. It's recognizing this ounce now purchases a long-term value-generating asset, so I'm converting stored purchasing power into production. That's the transition moment. It may not occur simultaneously, it may happen in waves, which is why you don't liquidate everything. You exchange in portions as ratios become attractive. Simple indicator. Watch the stock index to gold ratio. Divide the index number by gold's price. When that ratio falls, gold gains ground relative to equities. Historically, major financial regime shifts appear in this ratio. If the ratio continues compressing, it suggests rotation from financial assets into hard money. That matters because it indicates what future opportunities might emerge. If gold strengthens dramatically versus stocks, eventually exchanging gold for productive equities or businesses could become generational opportunities. But not today. Not while structural problems persist and policymakers pretend stability exists. Silver. Specifically, silver moves faster, with greater volatility. That volatility is precisely why silver can prove so powerful during transitions. When silver moves, it can shock observers. Suddenly, the affordable option becomes scarce. Question: when silver gains attention again, will average people easily purchase it at will? Or will they arrive late, encountering delays, premiums, and empty inventory, blaming others afterward? That's why you build positions before crowds become euphoric, not during. 2. Questions for you. I genuinely want your input. First, when considering your metals, do you think in price targets or purchasing power? Tell me your current mindset. Second, if the monetary order truly shifts, what's the first tangible asset you'd want to exchange metals for? Land, business, residence, equipment, something else? Share in comments, and if you've achieved any financial success, major or minor, share that too. Even paying off debt, building emergency funds, or making smart decisions. Your experience can motivate others more than you realize. The core theme. This isn't gold is rising. It's paper credibility is declining. When credibility falls, people demand higher compensation or simply exit. That's what capital conflict looks like. Not weapons, but flows. When flows change, markets move unexpectedly. If you're trying to time gold's peak while the world renegotiates trust, you're playing the wrong game. The better approach: hold the asset requiring no trust and wait for the world to offer tangible things for it. Practical do's and don'ts do. Maintain accessible physical metal core positions. Don't leverage it or borrow against it chasing trades. Do track key ratios monthly. Housing to gold, stocks to gold, land to gold, whatever matters in your situation. Don't obsess over daily price movements like gambling. Do build plans for what you want to acquire and at what ratios you'll exchange. Don't wait until news declares it safe. News is always late. Where this leaves us: we're in a world where precious metals aren't primarily trades, they're primarily protection, they're votes against currency debasement, they're methods of stepping outside the system's promises. Treating them this way makes you less likely to do what the system wants. Panic selling protection during manufactured scares. The big picture monetary system breakdowns don't follow clean lines. They break in phases. First, confidence erodes quietly. Then, markets send strange signals: bond volatility, currency weakness, sudden central bank shifts. Authorities respond with solutions, creating new distortions. Almost suddenly, the public realizes the game changed. The question isn't whether that moment arrives. It's whether you'll be positioned before it becomes obvious. My position: am I selling my metals? Not for paper. I'm holding, watching ratios, and preparing to exchange into tangible assets when opportunities become historic. If you want content on specific ratios to monitor, timing exchanges, and which assets make sense for different situations, indicate this in comments so I can tailor future content to actual needs. If you found this valuable, subscribe. It genuinely helps. And comment below to signal this deserves visibility and that you're part of this community. Take care of yourselves and each other. The deeper context. Let's slow down and zoom out, because focusing solely on price charts misses the larger picture unfolding behind them. When people say gold is performing well, that's incomplete. Gold isn't magically improving. Gold remains gold while the measurement tool shrinks. Understanding this changes the entire profit-taking conversation. Most people believe money equals the number on banking apps, the notes in wallets, the promises printed on paper. But currency units are political instruments: expandable, redefinable, dilutable. If you've never experienced currency instability, this sounds dramatic. If you have, you know people adapt rapidly. Prices stop being about currency units. They become how many groceries, how much fuel, how many months' rent. That's why I emphasize, stop asking if gold is expensive. Start asking what gold purchases. This isn't a normal cycle anymore. It's a credibility cycle. And credibility problems appear first where it hurts most: bond markets, bond market signals. Bonds should be stable and boring. The corner adults call safe. When long-term government bonds move violently, that's not noise. It's a flare. We recently witnessed long-dated bonds in a major economy sell sharply, then bounce. Some called the bounce relief. But bounces after sharp falls don't prove pressure disappeared. Often markets are catching breath. Why this matters: with huge debt loads, mathematics become unforgiving. Higher yields mean higher interest costs. Higher costs mean either spending cuts, tax increases, or money creation. Cut too much and growth breaks. Tax too much and social stability breaks. Print too much and currency breaks. Systems drift toward the short-term easiest option: financial repression. Keeping rates below real inflation, letting savers quietly pay the bill, calling it stability. That's why safe assets can become slow-motion losses. You may receive scheduled payments, but that money buys less. Again, if the measuring stick melts, selling your lifeboat for that measuring stick isn't winning. It's trading reality for promises. Inflation pressure. Let's address inflation, the invisible pressure pushing everything. Recent UK price data ticked higher. Whether trusting official numbers or grocery receipts, direction matters. If prices climb while deposit rates lag, cash loses ground. That's an unvoted tax everyone pays. When this happens globally, multiple countries debasing simultaneously, hard assets start repricing. Not because they changed, but because currencies did. Central bank behavior. Central bank behavior matters significantly. Don't focus only on tonnage. Focus on intent. If central banks reduce reliance on one reserve currency while building neutral reserves, that's strategic shift, not casual trading. Countries openly announce gold reserve increases and targets. That's planning, not randomness. Here's the retail impact. When institutions position first, the public follows with lag. When the public follows, the story becomes availability. Paper claims can be created infinitely. Physical metal cannot. That's why I separate price from access. Price quotes are opinions. Coins in hand are reality. Exchange checklist. Here's a checklist preventing classic mistakes. 1. Don't liquidate everything simultaneously. Exchange in portions. 2. Don't confuse profit with progress. Progress means acquiring life-improving or future-securing assets. 3. Don't ignore friction. Spreads, taxes, timing, delays. Matter, simple rule for regret-free partial exchanges. Exchange when three conditions align. First, ratios favor you in your context. Second, desired assets are high quality and actually available. Third, personal circumstances are stable enough that exchanging increases control rather than adding stress. If all three exist, act calmly. Otherwise, wait. Patience is a weapon during monetary transitions, and systems want breaking your patience with volatility and headlines. Community contribution. If you've achieved success, debt elimination, side income creation, savings building, smart investments, share in comments. It uplifts others and grounds this community in real outcomes rather than fantasies. Keep watching that stock to gold ratio mentioned earlier. When ratios reach extremes, generational opportunities appear, exchanging hard money into productive assets while crowds remain confused. My approach. No, I'm not seeking magic dollar numbers for selling. I'm seeking historic exchange opportunities. I'm monitoring system signals, ratio signals, and personal signals. When those align, I'll convert stored purchasing power into real productive ownership. Until then, I'd rather hold what's real than chase what's promised. Timing. Considerations. For those thinking strategically about timing, in markets, biggest gains typically come from positioning before crowds understand the story. Biggest mistakes happen when crowds finally understand and you assume the move finished. Here's the trap. If your plan waits for front-page announcements of new monetary eras, you'll be late. By the time average people believe currency dilution is happening, it already happened. By the time average people believe bonds are risky, yields already moved. By the time average people believe metals matter, easy physical supply was already absorbed. That's why exits aren't single moments. They're decision series. Those decisions become easier recognizing phases exist. Phase 1, denial. This is temporary. Phase 2, distraction. Chasing entertainment markets, ignoring boring signals. Phase 3, policy shock. Something breaks, authorities respond, markets swing. Phase 4, normalization. Public quietly adjusts to lower standards, calling it new normal. Phase 5, acceleration. Confidence drops faster. Pace surprises even experts. You don't need perfectly predicting phases. Just recognize they exist and don't reverse because commentators declare all clear. Silver context. Silver deserves specific attention because emotions run highest there. Silver can feel mocking, rallying when you're cautious, dipping when you're confident. That's normal. Silver is smaller relative to global markets, allowing more short-term manipulation. But that same smallness creates sudden upside potential when monetary demand and real-world demand converge simultaneously. If holding silver, treat it as the more volatile lifeboat. It may rock and splash, but it floats. If volatility worries you, the two-bucket concept becomes essential. Bucket 1, core. Don't touch unless buying life-changing or generational assets. Bucket 2, tactical. Rebalance if skilled or convert some gains without risking foundation. This prevents all or nothing moves destroying people psychologically. Capital conflicts. Another crucial angle, capital wars. Most people think conflicts only matter on maps, but modern conflict is financial, about who holds whose debt, who depends on whose currency, and who can exit without self-destruction. When countries run deficits, the other side involves someone holding their paper. If that holder loses confidence, flows change. When flows change, normal things suddenly look fragile. That's why reserve diversification matters, why neutral settlement assets matter, why you should never assume yesterday's safe asset remains tomorrow's safe asset. Your personal decision. If you're holding metals feeling pressure to act, remember, doing nothing is also action. Holding is a position. Waiting for ratios is strategy. The system tries shaming patience, calling it missing out or being wrong or fear. But during transitions, patience avoids forced bad trades. When opportunity finally appears, when real assets become inexpensive in gold terms, you want acting without begging for high-rate financing. Your metals become more than wealth. They become leverage in the real economy. Not debt leverage, optionality leverage. Don't think like day traders regarding long-term protection. Think like builders. Think like owners. Think like someone preparing to exchange stored purchasing power into decades of returns. If you want follow-up content mapping example ratios, housing to gold, land to gold, indices to gold, based on different regions and budgets, indicate this in comments. I'll build around your needs. Speed of change. Don't underestimate how rapidly public mood flips. For years, people ignore metals. Then one weekend, a bank headline hits, a currency drops, or a government announces new temporary controls, and suddenly everyone wants identical ounces simultaneously. That's when you witness real separation between paper and physical. Paper trades instantly. Physical encounters delays, limits, and premiums. Not because anyone's evil, because supply chains are real and inventory is finite. If holding physical, you're holding time and priority. If still building, build with consistency, not panic. Small, steady actions beat emotional sprints. Keep your composure, maintain your plan, monitor the signals. The next phase won't be gentle for the unprepared. Document your plan, inform family about basics, and maintain some liquidity for life. The objective is security, not stress.